Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we are going to be analyzing Marketaxess Holdings, ticker MKTX. This one came in by request down in the comment section of one of my other videos. If you have a request you'd like me to take a look at on the channel, put it down in the comments. I will get the ticker on the whiteboard behind me and eventually I'll make a video. If it's a stock that's in the S&P 500 like Marketaxess is, I post all those on YouTube for free. The rest I post over on Patreon at the $5 per month tier level. I also have a $25 a month tier level over on Patreon where I share a stock pick every single week. Basically, I look at the market, I find whatever the best value is that week that I can find, and that becomes the pick of the week. So far, they've been performing really well. Everyone's been happy with it, and it's off to a good start. I just started that service back at the beginning of October. But my long-running service is over on Seeking Alpha, which is called the Cyclical Investors Club. I've been running that service since the beginning of 2019, so what we're getting into close to our 6th year now. And if you do join any of the Patreon paid tiers, you get a big discount if you ever decide to join the full Cyclical Investors Club service over on Seeking Alpha. Those links will be down in the description for everybody. And I have a 25% off link for Fast Graphs, which you see me use here in most of my videos. They have free trials and stuff there too. So, if you just want to go try it out, use that link down there. And if you decide to stick with your subscription, then I make a little money off that. So, all right. As always, this is not individual investing advice. This is just how I analyze stocks. Marketaxess. So first I want to say that this would have been a very good stock to buy. I was just doing some research for the Cyclical Investors Club service. And this actually was one of the stocks that would have been great to buy. I forget the exact date, but back here when it was a little bit newer, somewhere around here, you could have got a 10 bagger, I think, out of it. Yep. And more than that, actually. So a person that bought the stock back then would have done really well. But it got to a period in the late 20-teens, I guess you would call them, where it was pretty richly valued. We're looking at like 50 PEs, mid-teens earnings growth, slowing off the 20% earnings growth that we were seeing before that. And then, of course, one of my big things I've been talking about lately is it was included in the S&P 500 at a very rich valuation. Let's see, I have it here on July 1st, 2019. So I think 7 is July. We'll go to right there. And so however many years that was ago. And now the stock is down about 25%. If you include the dividend, it's only down about 5%. But inflation's been up 25% since then. And the market's doubled basically since then. So really another poor investment by the S&P 500 that nobody's going to talk about. And like usual, the smart traders made some good money before that inclusion. So if we assume maybe they sold a little bit after that 1 year before going in, I made 70%. I think if they would have picked it up at the bottom here, would have done 100% return. Average return 12 months out of S&P 500 inclusion is about 130%. I did that research during the past like 3 or 4 years, like 3 years, I think. So this Marketaxess wasn't included in that, but the same pattern holds. Now, obviously, it jumped even higher during the boom, the bubble, whatever you want to call it. Before it sold off. So these guys are like, they do like bond, it's like a bond exchange, I guess, basically. They call it an exchange? Exchanges and data, yeah. For bond trading. So I didn't look super deeply into it, but it looked to me like they're basically just like an online exchange where you could trade bonds. And they probably have services and stuff that go along with that. So let's look at, now overall, other than this crazy high valuation that it experienced, and if you smooth out this bump, which had like a bust afterwards, but it wasn't like super bad, if you just look at the overall pattern, they've grown really well. So I don't want to take that away from the business just because the investors paid way too much for the stock the past several years. Now we're at a 35 PE, which is still pretty high. So it's not even, it got down to a 27, it looks like, at one point. So nothing against their business. It's pretty solid. We would expect after a 45% kind of bump here that we would see a year or two of decline. And that's what happened. And then you just think all the extra trading that was going on during the pandemic too probably boosted them. So now we've had a couple of years of single digit growth. And the question is, if they do start growing double digits again, it's not quite enough to justify. Well, we'll look at the valuation here in a second. But, there's just because the stock is like, I don't know, it's probably 70% off its high. Let's see. 55% off its high right now, or maybe closer to 60, probably 70 at this bottom here. Just because the stock price is down doesn't mean like there's necessarily anything wrong with the business. So I just we'll get to that spreadsheet in a second. I want to make sure it was still loaded. All right, let's look at this time frame from like 2016. Well, I probably would bump this forward, honestly, because that 31% growth year, those days are probably gone. And we're already going to get this 45% year. So these teens are probably what I would look at. And then I like to include these declines as well. And we haven't actually had these extra teen years. So like this is kind of the time frame I would look to try to determine what the earnings growth rate might be. It's about 10% here on the fast graph. If they've been buying back shares, I back those out in my earnings growth estimates, which we'll get to in just a second. But that kind of gives you an idea. We're looking at maybe like 10% growth. Doesn't look like they really have any debt, so that's cool. So let's get into the calculation for the earnings. So the idea here is I like to treat these as like I'm buying the businesses and how much I'm paying for the future earnings of the business. So my earnings growth rate is almost 10%. It's almost the same as what's on the fast graph here. That's this number right here. That's based on, a time frame kind of like I showed you in the fast graph since about 2017. I think that's a pretty reasonable estimate going forward. Analysts are thinking mid-teens, but they're probably being optimistic, I think. The last 2 years were single digits, and the 2 years before that, earnings growth was negative. So I think 10% is fair earnings growth estimate. If you look at the 3-year revenue growth, they're only growing about 3% a year revenue the cumulative growth the past 3 years. So that's way slower than this. So I'm actually probably being pretty generous. I'm assuming that's coming off kind of a boom, so we should expect a little consolidation and building a new base of earnings, and then we'll see what kind of growth rates we get going forward. But that's where that's where this number comes from. So what I want to know is, if I bought the whole business for $100, how much in earnings would I earn on my $100? So that's basically the earnings yield, which is the earnings over the price instead of the price over the earnings. So I actually gave them a little credit because it looks like they have like a little bit of net cash, because the real stock price is $260. I'm treating it like it's $252, basically the same, but so that's a PE of almost 36. And when you convert that into the earnings yield, which you just flip the two metrics around, the price and the earnings, you get 2.87%. So 2.87% of $100 is $2.87. So for every $100 of this business you buy, the company is going to earn about $2.87. Okay? And then that's going to grow at that. It was like 9.93% growth rate. So that $2.87 is going to grow about 10% a year. I pull the first year forward, so I assume if I start with $100, I would end with $103.16 the first year. And that $3.16 would grow at 10%, and then I could collect that money each year. So what I want to know is how much money I could collect after 10 years. And I would collect about $50, $50.13. So I start with $100, I end with $150 after 10 years. If you put that in a CAGR calculator, comes out to about, where are we at here? 4.15% CAGR, earnings CAGR. So that's lower than like a 10-year treasury bond. So that means it's very expensive. Like your return is not going to be very much because you're paying a lot for future earnings. I want this number to actually be over 8% before I would consider buying. That's 60% lower than the stock price trades today at a price of 102. So I don't know if I double checked that, but to make sure my last update. Okay, so it's actually going to be a little bit higher than that. So because I hadn't updated this number, I was just watching the other one. So what I can do is just check different prices here, just try to get one that's about 8%. So about 112 is what we're looking at instead of 102. So let's see. That's because earnings have gone up a little bit since I last updated it. So that's about 57% lower than where it is now, $112 a share. That's when it would hit my buy threshold. Now that would include a margin of safety and trying to get a higher return. So at some point along the way there, about 6.5% 10-year CAGR is what I would consider fair value, like the midpoint of fair value. So that the fair value price would come before the buy price. It would be higher than the buy price. But I want to get a margin of safety and then try to get better returns. So I wait out and see if I can get things when they're cheap. The recession PE thing, the recession PE buy price is almost the same. So they're pretty much pointing to the same thing. It's just way overvalued. And honestly, you don't have to be a genius to look at it. You can use kind of a basic PEG ratio. So typically a PEG, which is the earnings growth rate combined with the PE ratio. So, or let's see, it would be PE divided by the earnings growth. Usually a 1 is considered a good deal. So if the PE is 35, you would want the earnings growth to be growing, the earnings to be growing at 35% to get a good deal. A PEG of 2 is usually like okay, like it's like fair value-ish range. Kind of depends on what else is going on in the market. But right now, like a PEG of ratio of 2 would be decent. So earlier when it traded at a PE of 28, if you really thought earnings were going to grow in the mid-teens these next couple of years, like analysts do, so they're looking at like 13 or 14%. Well, back in, let's see, June, when it traded down below $200 a share, that would have been a PEG of about 2. That would have been, kind of fair value, but people bought it up at that point. Now, right now, let's see, it depends on what earnings growth rate you want to use, but you're getting close to a PEG of 3 if you use a 13% earnings growth rate and a 36%. I have a calculator. Let's just look and see. Let's just take 35.68 divided by 13. 2.74 PEG. So again, that's saying it's really expensive. Like it's when you get up to a 3, that's when you usually are thinking about selling on a PEG ratio basis. So again, it's just the valuation doesn't really make any sense still, and it hasn't made sense for several years, but it's just taking a while for the market to slowly come to grips with that. Basically since it got included in the S&P 500, it hasn't been in the year leading up to that, it hasn't been, a decent value. But they can stay overvalued for a while, but you can tell what happens ultimately. People that bought this stock, let's say back when let's say all the index investors that bought it and didn't know it after it got put in the S&P 500. So all those folks putting money in their retirement account, that was in 2019. So 5 years ago plus, and they've lost money that whole time. But if you look, the earnings are actually probably higher. So yeah, if you use the forward earnings back then, $5.40 a share, this year they're going to be $7.35. So the earnings grew a lot. Grew maybe not quite 50%, but 40% during that time. But the stock price fell. Well, that's because people paid too much money for it. So all those index investors paid too much money for it. They don't know it, but they did. And they're slowly losing money. And the people that sold the stock to them back then are making money. And then all the people that got sucked in on the boom are losing a lot of money. So if you bought during when everybody was being crazy, and they're down more than 50%, and the stock is going to keep falling, probably, over time. So until we get an earnings bottom and it'll sort itself out, and then maybe it'll start kind of growing again. It's possible that this was a bottom back here in June at just under $200. Totally possible. Earnings could catch up. The market likes it, and it could have a new growth trajectory after that. But in the meantime, you spent 5 years where you didn't make any money. So it's a real opportunity cost when you could have doubled your money and instead you lose 25% and inflation's up 25%. So you don't want to do that. That's why these valuations matter. And sometimes I've had comments where people are like, well, let's go back here. Before the stock fell, it rose 70%. And that's true. But you had to also sell at that point, and I'm not sure what metric exactly you would. Now, you could use like some momentum thing. So you would have dumped it right here when the rest of the momentum people dumped it, or right here when the Head and Shoulders formed. There's traders that can trade this, obviously, but when you're using fundamentals, it takes years. It takes a few years sometimes for them to just, it's like having a weight on the stock. All right. If you found this useful, hit the subscribe button, the like button, check out those Patreon links. And if you have any questions, let me know in the comments, send your requests. I will get them on the board, and I'll see everybody later. Bye.